So let's talk about this listing I have in Tacoma Park, 7203 13th Place. You did a beautiful little flyer for it that I'm going to upload on Facebook and link it to the post so that people can see. But I wanted to break it down for people so they could see in real time kind of numbers, like if you were to buy a house like this, what it looks like and what your options are. So 579,900 is what the list price is. Super cute 4-bed, 2-bath house with detached garage. And
it's super cute. You're right.
Super cute. Did a little tour there yesterday. So tell us what your options are. Say you're a first-time home buyer or a second-time home buyer. What is the least amount that you could put down right now, and what are some things to consider as you figure out what the numbers look like?
Sure. So there's still a lot of programs available that allow for lower down payment. Conventional mortgages at this price point, contingent upon what the income is, you can get a conventional loan at 3% down.
Which is how much? So on that sales price, 3% is how much?
580 is $22,000.
Got it.
Right.
Okay.
Yeah.
22,000 is what you would need down, plus closing costs, unless you, which are about 3%, but sometimes people figure that into their offer.
Right. Actually, no, I'm sorry, I said that wrong. 3% is going to be closer to like $18,000. So,
okay.
Contingent upon if you can. So $18,000 your down payment, and then you're going to have your closing costs. Typically, closing costs are about 3% of the sales price, 3 to 3.5% of the sales price. So
for
with that being
$580,000, if you put about 3% down, it costs you about $18,000 to get into that house. If for some reason you work in then your closing costs, or even if you pay the 3% on top, that's the max cash you'd have to outlay.
Right. You're about $35,000, in between $30,000 to $36,000 out of pocket.
Got it.
And with that, you're looking at one beautiful home. You have, what did you say, 4 bedrooms?
Yep, 4 bedroom, 2 bath.
4 bedrooms, and in a property like that, you're paying $2,700 a month.
That's with your taxes and your insurance.
That's principal, interest, taxes, and insurance. So
total all in $2,700 a month if you put 3% down.
That's 3% down, correct? Yeah. Now your next available option is going to be a conventional 5% down. 5% down is going to drop your payment clearly because you're financing less.
Right.
So you're going to be closer to. I said that incorrectly. My apologies. 3% down, you're probably going to be closer to like $3,600. Your principal and interest payments for $2,600 or $2,750, $3,600. 5% down, you're going to be closer to like $3,500 a month.
$3,500, 5% down. Okay.
Correct. Yep. Your next available option is going to be a conventional 10% down. 10% is going to be $3,320 a month, and then 20%, which 10% is $57,000, almost $58,000, plus your closing cost of 3%. Then your next option would be a conventional 20% down. 20% down's almost $116,000 plus your 3%, and your payment's $2,915 a month.
And just so people know, so when we talk about the PITI, that's your principal, interest, tax, and insurance. And insurance isn't that much usually for a house like this. Maybe what, $1,000 to $1,200 for the year, the whole year. The taxes are going to depend. Tacoma Park tends to have a bit higher taxes because it's a municipality.
Taxes on this house are $570 a month.
$570 a month, and then you have your mortgage payment with principal and interest. Okay.
So the way that a mortgage works with your PITI is you're paying principal and interest, which is your loan.
Yeah. And
then you're paying your taxes and insurance. So when you have a mortgage, it's kind of like you have 2 buckets, if you will. One bucket is your loan that on a monthly basis, you're paying that balance down. The other bucket is what's called your escrow account, which really each month that you make a monthly payment, you're adding money into that escrow account. So when your taxes, which are semi-annual, and your insurance is annual, the servicer that has your mortgage will disperse those funds for you. So it's kind of like a forced savings tool, if you will, right? You're going to have to pay your property taxes twice a year. You're going to have to pay your insurance once a year. So when putting it into an escrow account, it's essentially you have one lump sum payment. It all goes into this your mortgage payment, and then the servicer disperses the funds for you.
Much easier.
Much easier, yeah.
And then for this house, for example, if you were a VA buyer or an FHA buyer, what's going on with those type of loans right now?
Sure. So VA, you have to be a veteran.
Right.
So you have to be eligible for the VA mortgage. VA mortgage is probably, and honestly, I think it should be the best type of mortgage available, the best product, the best terms.
You can put
VA
down with that too, right?
VA is 100% financing. There's no mortgage insurance with VA. VA has what's called a funding fee, but VA allows you to finance it into your total loan amount. If the veteran is 10% or greater disabled, they don't have any funding fee at all. FHA is another, call it reduced down payment loan. It's 3.5% down as your minimum. Now, this is one of the guidelines that have changed recently, is that FHA allowed for really like a 560 loan amount. And there's a lot of banks that are starting to change guidelines on that. So right now, our company's at a minimum of a 640 credit score. There are some companies out there right now that those numbers have changed and they're up to 680. There's some that are going to 700 right now.
Wow.
So really important, if you've started with a lender and you're pursuing financing, that maybe you were putting down a low down payment, or your credit scores were maybe lower than 700. It's very advantageous right now to call your lender and talk to them, make sure that they still have the same product or program that you had looked at prior to.
So if you got qualified even 3 months ago, at the beginning of the year, and you felt like you were good to go, you got to check now with your realtor and your lender to make sure that those programs are still available, everything still makes sense, and that you still qualify.
Yes, correct. Yep. The landscape has changed so much that it does make sense that, call back whoever you were working with, or just do a quick double check and make sure that what you were pursuing prior to is still available.
And one thing I like about working with you is that you will talk to people and help them through, like, say, for example, the limit, their credit score is below the limit, that you can give them ways to try and increase that within a short amount of time, or reasonable amount of time, so that there's a light in the tunnel and they can buy their home and get their credit score up to have the numbers make sense for them.
Absolutely. I talk to a lot of people, and up front they'll tell me, I don't know if I'm ready. My credit scores aren't there. And I always ask the question, well, what are you doing to increase them? A lot of times they just don't know the answer. So for us, part of our job is to help increase those credit scores. With doing that, we have to pull credit. We have to see what's on the credit report and what we should take care of first. And at times the client might have some cash they can allocate towards taking care of or improving their credit scores, but they just don't know which direction to go into. So it's worth connecting with somebody, talking to a lender, having them pull your credit. There's no cost associated with it, and getting good advice as to where you're allocating money and why.
That makes sense.